have a bullish reversal pattern called a double bottom, which is formed by two lows that are at the same price level. It represents a bullish reversal pattern. So price will fall, and then a double bottom will appear, signaling an upward reversal. When the breakout line from number 2 is broken to the upside, the double bottom is confirmed. This pattern's logic is based on the simple mechanics of highs and lows. A double bottom in the chart indicates that two lows hit the same level, indicating that the second low failed to fall below the first. This is a sign of the seller's weakness because they were unable to surpass the last level they created. If the price can break above the high between these two lows, it indicates that buyers are gaining power over sellers. So, not only did sellers fail to make a lower low, but buyers were able to break the previous level from which sellers came. Because this breakout line is only formed by the high in between two lows, it can only be a horizontal line. The best way to trade the double bottom pattern is to wait for price to break above the line and retest it as support, as we previously saw. You should watch to see if price reacts to the breakout line as it retraces back to it. If it does, it's time to enter a long trade with stops below numbers 1 and 3. That is the logical stop-loss order, because price breaking above the line confirms a demand zone in low number 3. As a result, that zone will act as a cushion of protection for your stop. Of course, it doesn't always work, but by applying this logic, you can increase your chances of avoiding a stop loss. The target should be 3 times the size of the stop loss. You should not move your stop and take profit targets once they have been set. You must wait for the market to reach either your stop or your target. The double bottom is a bullish reversal pattern. While the double top is a bearish reversal pattern. This pattern is made up of two highs that are at the same price level. It represents a bearish reversal pattern. So, price will rise, and then a double top will appear, signaling a downward reversal. When the breakout line from number 2 is broken to the downside, the double top is confirmed. The logic behind this pattern is based on the chart's simple mechanics of highs and lows. A double top occurs when two highs appear at the same level, indicating that the second high failed to rise above the first. This is a sign of the buyer's weakness because they were unable to surpass the last level they set for themselves. If the price can break below the low between these two highs, it indicates that sellers are gaining power over buyers. So, not only did buyers fail to create a higher high, but sellers were able to break the previous level from which buyers came from. This breakout line is formed by the low that falls between two highs. As a result, it can only be a horizontal line. Waiting for price to break below the line and retest it as resistance is the best way to trade a double top pattern. Just as we've seen before. You should keep an eye on price as it retraces back to the breakout line to see how it reacts to the line. If it does, now is the time to enter a short trade with a stop above numbers 1 and 3. That is the logical stop-loss order, because breaking below the line confirms a supply zone in high number 3. As a result, that zone will act as a cushion of protection for your stop. Of course, it doesn't always work, but by applying this logic, you can increase your chances of avoiding a stop loss. The target should be 3 times the size of the stop loss. You should not move your stop and take profit targets once they have been set. You must wait for the market to reach either your stop or your target. Some traders do not wait for price to retrace back to the breakout line, but as previously stated, this can be a little riskier because your stop loss size will be larger because you will be entering in a worse position. Traders do this because they are afraid of missing out on an opportunity, so they sacrifice a little bit, sometimes a lot, just to be a part of the trade. However, acting in this manner will harm your equity curve in the long run. This is the end of part 2, thanks for watching. Don't forget to like, subscribe and ring the bell to get notified for part 3. See you in the next one.